Are you constantly feeling like you're trading your most valuable asset, your time, directly for cash? Just tired of that treadmill where every single dollar, every rupee requires your active effort? Well, today we're going to tackle that head on. We're talking about the power, really, of making money while you sleep. We're doing a deep dive into dividend investing. We've gathered quite a few sources, actually, all aimed at helping you get up to speed fast.
Exactly. That's the mission today. We know our listener, you, might be starting out needing clearer definitions, practical steps. So we're going to pull out the core mechanics, the key strategies, and yeah, the important warnings from these sources. The goal is to show you how to build passive income with dividends.
Okay, let's jump right in then. The absolute basics first. What is a dividend? Why should we even care? It seems simple, right? You buy a share, you own a tiny piece of that company.
And that's the crucial part, ownership. Some companies, usually the more established, profitable ones, decide, hey, let's share some of this success. They take a slice of their profits and send it out as cash to shareholders.
And that cash payment, that's the dividend.
That's it. And importantly, like you said, it often just shows up in your brokerage account. You didn't have to sell the share to get it.
Okay.
Yeah, there's a great analogy in the sources we looked at. Think about owning a tiny piece of a really successful local bakery. You don't bake the bread, you don't run the till.
Right, you're just an owner.
Exactly. But because you own that slice, every month or quarter, they send you your share of the profits. It's the same idea, just with big public companies.
That really shifts the perspective, doesn't it? Away from just watching stock prices wiggle up and down.
It completely does. Dividend investing moves your focus from just hoping the price goes up, that's capital appreciation, to focusing on generating cash flow, real money coming into your account regularly. That cash flow is what builds independence.
That distinction feels really important. Okay, so we know what they are. Let's talk about why this strategy is so powerful for building that passive income stream. What makes it work?
Well, there are a few big reasons. First, and most obviously, it's a passive income stream. The company earns money, you own part of the company, so you get paid. It's not tied to your direct labor.
Just for owning the asset.
Precisely. The second big thing, which offers a lot of peace of mind, is it can be lower stress investing. Think about it. Even if the stock market has a rough month, or your specific stock's price dips for a bit, those dividend payments often keep coming because they're based on the company's actual profits, which tend to be more stable than market sentiment day to day.
Okay, that makes sense. Less panic selling, maybe.
Potentially, yeah. But the real sort of aha moment, the engine behind building serious wealth here, has got to be the next point.
Which is?
The compounding effect. This is where the magic really kicks in. It's that snowball analogy you always hear about.
Right. Explain that.
So you get your dividend payment, let's say it's $50. Instead of just spending it, you use that $50 to buy more shares of the same company, or maybe another dividend payer.
Okay, so you own a little bit more now.
Exactly. So next quarter, because you own more shares, your dividend payment will be slightly bigger, maybe $51. You reinvest that, now you own even more shares.
And the next payment is even bigger.
And so on. It accelerates. Your income doesn't just grow, it grows faster over time. It's exponential growth, fueled by reinvesting those dividends.
And that snowball, that compounding, that connects directly to the big goal, right? Financial freedom.
Absolutely. The sources frame it as eventually reaching a point where those quarterly dividend checks add up to enough to cover your living expenses, rent, food, utilities, maybe your whole lifestyle, without having to actively work for that income. That's the end game for many dividend investors.
Replacing your earned income. Wow. Okay, powerful stuff. But we need to make a key distinction clear for everyone listening. You can't just buy any stock and expect these checks to roll in, can you?
No, definitely not. That's crucial. You need to understand the difference between dividend stocks and growth stocks. They have very different philosophies.
Okay, break that down.
So dividend stocks are typically your mature, stable companies. Think about utility companies, big established banks, major consumer brands companies making things you buy regularly. They're usually past their hypergrowth phase.
They make steady profits.
Right. And because they don't need all that profit for massive expansion anymore, they reward shareholders by paying out a portion as dividends. That's their main appeal. Steady income.
Okay, so what about the other side? Growth stocks.
Growth stocks are often tech companies, maybe biotech, companies trying to disrupt an industry. Think about Amazon or Tesla in their early days. Their main goal is to grow as big and as fast as possible.
So they need all their cash.
Exactly. Every dollar of profit gets plowed right back into the business, research, expansion, marketing, acquisitions. They choose not to pay dividends because they believe they can generate a much higher return for shareholders by reinvesting that money internally.
So it's a trade-off then. Income now versus potential for much bigger price growth later.
That's the fundamental choice. If your number one goal right now is building a passive income stream, then dividend stocks are your focus. If you're maybe younger, have a very long time horizon, and don't need income today, you might lean towards growth stocks, hoping for that massive price appreciation down the road.
But if the goal is cash flow to live on or reinvest now, dividend stocks are the clearer path.
Generally, yes. They solve the income problem more directly.
Okay, that makes a lot of sense. So let's say you've decided dividend investing is the route for you. How do you actually pick the right ones? How do you avoid companies that might look good but end up cutting their dividend? This is the practical toolkit part.
Yes, this is super important. The sources highlight 4 key metrics you really need to look at. Let's start with the one most people know, dividend yield.
Right, the yield. That's just the annual dividend payment divided by the stock's current price, expressed as a percentage. Like a $100 stock paying $4 a year has a 4% yield. Simple.
It seems simple, but here's the first big warning. Be very careful with super high yields. If you see a stock yielding 10%, 12%, 15%,
That sounds great.
it sounds great, but it's often a massive red flag. A yield usually only gets that high because stock price has crashed. And why did the price crash? Often because the market thinks the company is in trouble and might have to cut that dividend soon.
Ah, the dreaded yield trap.
Exactly. You buy for the juicy yield, then they cut the dividend, and the stock price falls even further. So a moderate, sustainable yield is often much safer than an abnormally high one.
Okay, crucial point. Don't chase massive yields blindly. What's metric number 2?
This one is maybe even more important for long-term wealth. Dividend growth. You don't just want a company that pays a dividend. You want one that increases it consistently over time.
Why is that so vital?
2 main reasons. First, it protects you against inflation. If your dividend stays flat but costs go up 3% a year, you're losing purchasing power. Consistent dividend growth, ideally faster than inflation, means your income keeps its value or even grows in real terms.
And the second reason,
It's a strong signal of management confidence. A company that consistently raises its dividend is basically telling the market, we expect our profits to keep growing, and we're committed to sharing that growth with our owners.
okay, so look for a history of increases. Got it. Metric number 3. This sounds a bit more technical. The payout ratio.
It sounds technical, but the concept is straightforward. The payout ratio is simply the percentage of a company's profits that it's paying out as dividends.
Right, so if they make $100 million and pay out $50 million in dividends, the payout ratio is 50%.
Exactly. And this tells you about sustainability. If that ratio is super high, like 85% or 90%.
They're paying out almost everything they earn.
Yeah, which leaves very little money for reinvesting in the business, paying down debt, or having a cushion if times get tough. If profits dip even slightly, they might be forced to cut the dividend.
So what's a healthy range?
The sources generally suggest looking for payout ratios somewhere in the 40% to 60% range for most stable companies. That shows they can afford the dividend and still have money left over for growth and safety.
Okay, not too high, not too low. Makes sense. And the final metric.
This underpins everything else. Strong financials. You have to look beyond just the dividend numbers. Is the company consistently profitable? Does it generate good cash flow? Crucially, how much debt does it have?
Why is debt so important here?
Because high debt levels are risky. If interest rates rise or the business stumbles, debt payments have to be made. And if cash gets tight, the dividend is often one of the first things cut to make sure bondholders get paid. Low debt means more financial flexibility and a safer dividend.
Consistent profits, good cash flow, manageable debt. Check. And the sources mentioned a kind of shortcut for finding companies that often tick these boxes, right?
Yes, the pro tip, as you called it. Many experienced investors focus on the dividend aristocrats. These are specific S&P 500 companies that have not just paid, but increased their dividends for at least 25 consecutive years.
25 years of increases.
Yeah. That kind of track record is about the best evidence you can find of financial stability, consistent profitability, and a deep commitment to returning cash to shareholders through thick and thin.
That's a really useful filter. Okay, so we know what to look for in an individual stock. Now, how do we put it all together? Building a portfolio and managing the inevitable risks.
Right, because picking one great stock isn't enough. The absolute first rule is diversification. You cannot put all your eggs in one basket or even one industry.
Don't just buy bank stocks, for instance.
Exactly, or just energy stocks. If that one sector hits a rough patch, your entire income could suffer. You need to spread your investments across different sectors: healthcare, consumer staples, utilities, maybe some tech, industrials.
And within those sectors, maybe mix up the types of dividend stocks.
That's a good point. A strategy mix can be smart. You might have some stocks with higher initial yields, maybe in the 3–5% range for immediate income, and then combine those with stocks that have lower starting yields but much faster dividend growth rates, those aristocrats, for example. The growers help boost your income over the long term.
Okay, but researching dozens of stocks across different sectors sounds like a lot of work, especially for someone starting out.
It definitely can be, which is why the sources strongly highlight the option of using dividend ETFs, exchange-traded funds.
How do those help?
Think of an ETF as a basket that holds lots of different stocks, often hundreds. A dividend ETF specifically holds a basket of dividend-paying stocks, usually already diversified across many sectors according to the fund's rules.
So you buy one thing, the ETF, and instantly own pieces of many dividend companies.
Precisely. It gives you instant diversification. It's usually low cost. You don't have to pick individual stocks, and it solves that "where do I even begin" problem for a lot of people. That seems like a really practical starting point. And you mentioned earlier, we have to stress this again, reinvesting those dividends, especially at the beginning.
Absolutely critical. We talked about compounding. Reinvesting is how you make it happen. When you start, those dividend payments might seem small, maybe $10, $20 a quarter. It's tempting to just take the cash.
But you should put it back to work.
Yes, reinvest it automatically if your broker allows it. Buy more shares, even fractional shares. Every little bit you reinvest buys you more future income. It's like watering that money tree consistently. That's how you get the snowball rolling fastest.
Okay, super important action step. Now, we have to be balanced. This isn't foolproof. What are the risks we need to acknowledge?
Definitely not risk-free. First, and most obviously, companies can cut or stop paying dividends. It happens. If a company faces a major crisis, a severe recession, or just bad management, the dividend might be reduced or eliminated to save cash.
Even the stable ones.
It's less common with the very stable ones, but it can happen, especially in cyclical industries that are very sensitive to the economy. What else?
Well, even if the dividend stays safe, the stock price itself can still go down. Dividend investing doesn't make you immune to market volatility. Your portfolio value can still fluctuate.
Okay.
And the third big risk, often underestimated, is inflation risk. If you own a stock that pays a 3% dividend, but inflation is running at 4% or 5%, the actual buying power of your dividend income is shrinking each year.
Right. Your money doesn't go as far.
Exactly. That's why focusing on dividend growth, not just the current yield, is so crucial. You need that income stream to ideally grow faster than inflation over the long haul.
So the main defenses against these risks seem to be what we've discussed. Diversify widely, do your homework using those metrics, yield, growth, payout ratio, financials, and importantly, maintain a long-term perspective.
That's it. Don't panic during market dips, focus on the income stream, keep reinvesting, and understand this is a strategy that plays out over years, even decades.
Okay, let's wrap this up. To summarize, dividend investing isn't about getting rich overnight. It's a methodical, patient approach focused on building a reliable, growing stream of passive income over time.
Think about that long-term vision. Picture yourself 10, 15, 20 years from now. Imagine those regular dividend payments arriving, maybe covering your utility bills, then your groceries, eventually maybe even your rent or mortgage, all generated by the assets you own without you needing to trade your time for it anymore. That's the potential power here.
That's a compelling picture. So the final thought we want to leave you, the listener, with, based on everything we've unpacked today, the need for stability, strong financials, consistent profits, maybe low debt. Think about this. What specific industry, maybe one that's not the usual suspect like utilities or banks, do you think shows the characteristics needed to potentially produce the next generation of dividend aristocrats? Mull that over, apply those metrics we talked about. Thanks for joining us for this deep dive.